Hey there, and welcome back to the channel. If you are 65 or older, then what I am about to share with you in the next few minutes could genuinely change the way you think about your finances. And more importantly, it could put real money back into your pocket. So please do not skip ahead, because this is exactly the kind of information that most people never find out about until it is far too late. Now, here is something that most people do not realize. The IRS, yes, the same organization that most of us have feared our entire working lives, actually has programs, provisions, and special rules built right into the tax code that are specifically designed to help older Americans reduce or even completely wipe out certain financial burdens. And the shocking part? The government does not go out of its way to advertise these benefits. In fact, many tax professionals do not even bring them up unless you specifically ask. So today, we're going to walk through 5 specific bills and financial burdens that the IRS can quietly erase for seniors who are 65 and older. These are not rumours, these are not tricks. These are real, legal and legitimate provisions that exist within the United States tax system. And by the end of this video, you are going to have a much clearer picture of what you may be leaving on the table every single year. Let us get right into it. Bill number 1. Your medical and healthcare expenses. The very first bill we are going to talk about is one that hits almost every senior household hard, and that is medical and healthcare expenses. Let us be honest. Once you reach your mid-60s and beyond, healthcare costs tend to skyrocket. Whether it is prescription medications, doctor visits, specialist appointments, hospital stays, dental work, vision care, hearing aids, or even certain home modifications made for medical purposes, the bills add up fast. And for many seniors living on a fixed income, these expenses can feel absolutely crushing. But here is what the IRS quietly allows. Under the current tax code, seniors who are 65 and older can deduct medical and dental expenses that exceed a certain percentage of their adjusted gross income. And what makes this especially valuable for older Americans is that this threshold is lower for seniors compared to younger taxpayers, meaning you get access to this deduction at a lower income level than most working-age adults. So what kinds of expenses qualify? We are talking about things like prescription drug costs, health insurance premiums, including Medicare Part B and Part D premiums, long-term care insurance premiums, nursing home costs, the cost of medical equipment, transportation costs related to medical care, and even certain mental health services. The list is actually quite extensive. Now, the key thing to understand here is that you need to itemize your deductions in order to claim this benefit. That means instead of taking the standard deduction, you would be listing out all of your qualifying expenses one by one. For some seniors, especially those with high medical cost, this can result in a significantly larger deduction than the standard option would provide. Many seniors never explore this option, simply because they assume the standard deduction is always the better choice. But that is not always true, especially if your medical bills have been unusually high during the tax year. The math might actually work out in your favour more often than you think. Bill number 2, your Social Security taxes. The second bill that many seniors do not realise they may be able to reduce or even eliminate is the tax on their Social Security benefits. That is right. A lot of people are shocked to discover that Social Security income can be taxed. But what they are even more surprised to learn is that depending on your total income, you may owe little to nothing in taxes on those benefits. And if you plan your finances the right way, you might be able to reduce that tax burden significantly. Here is how it works. The IRS uses something called your combined income to determine how much of your Social Security benefits are subject to federal income tax. Your combined income is basically your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefits added together. If your combined income falls below a certain threshold, then your Social Security benefits are not taxed at all. If it falls in a middle range, then only up to 50% of your benefits may be taxable. And if it goes above a higher threshold, then up to 85% of your benefits could be subject to tax. But here is the important part. Up to 15% of your Social Security benefits are always tax-free, no matter how much money you make. So what does this mean in practical terms? It means that by carefully managing your other sources of income, things like withdrawals from retirement accounts, investment income, and other earnings, you may be able to keep your combined income below the taxable threshold and effectively erase the tax on your Social Security check completely. This kind of strategic income planning is something that a knowledgeable financial advisor or tax professional can help you with. And for many seniors, it makes an enormous difference in their overall financial picture, year after year. Bill number 3, property taxes and housing costs. The third area where seniors can get significant financial relief is with property taxes and housing-related costs. Now, it is important to understand that property taxes are primarily handled at the state and local level, not by the IRS directly. However, the federal tax code does still play a role here, and there are important connections between federal tax rules and the property tax relief programs that many seniors are entitled to. For starters, if you are a homeowner who itemizes deductions, you may be able to deduct your state and local property taxes on your federal tax return. This is known as the SALT deduction, which stands for State and Local Tax Deduction, and it can help reduce your federal taxable income based on what you are already paying in property taxes at the local level. Beyond the federal connection, nearly every state in the country offers some form of property tax relief, specifically for senior citizens. These programs go by different names depending on where you live. Sometimes they are called homestead exemptions, senior freeze programs, circuit breaker credits, or property tax deferrals. But the bottom line is that many older homeowners are completely unaware that these programs exist, and they are leaving significant savings on the table every single year. Some of these programs can reduce your property tax bill by hundreds or even thousands of dollars annually. Others allow you to defer your property taxes until the home is sold, which can be incredibly helpful for seniors who are asset-rich but cash-poor. And in some cases, senior homeowners with very low incomes may qualify for near-complete exemptions from property taxes altogether. The key to accessing these benefits is knowing they exist and then taking the steps to apply for them. Most programs require you to fill out an application through your local county or municipal tax office, and eligibility is often based on your age, income level, and the value of your home. If you have not looked into the property tax relief programs available in your area, this is absolutely something worth investigating right away. The savings can be substantial. Bill number 4, capital gains taxes on your home sale. Now let us talk about the fourth bill that the IRS can quietly erase for seniors, and this one involves the taxes on the sale of your home. If you are 65 or older and you are thinking about downsizing, moving closer to family, relocating to a warmer climate, or transitioning into a retirement community, you may be sitting on a home that has appreciated significantly in value over the years. And when you sell that home, you might be worried about having to hand over a large portion of your profit to the IRS in the form of capital gains taxes. Here is the good news. The federal tax code includes a powerful provision called the home sale exclusion, and it allows qualifying homeowners to exclude a very significant amount of capital gains from federal income tax when they sell their primary residence. Specifically, if you are single and you have lived in and owned the home for at least 2 of the last 5 years, you can exclude up to $250,000 in profit from taxation. And if you are married and filing jointly, that exclusion amount doubles, meaning you and your spouse together can exclude up to $500,000 in profit from the sale of your home, completely free of federal capital gains tax. For many seniors, this provision effectively eliminates the capital gains tax on their home sale entirely. Think about that for a moment. If you bought your home decades ago for a relatively modest price, and it has grown in value significantly over time, you could potentially walk away from that sale with hundreds of thousands of dollars in profit without owing the IRS a single cent in capital gains taxes, as long as you meet the eligibility requirements. And even if your gain exceeds the exclusion limit, you only pay capital gains tax on the amount above the threshold, not on the entire profit. That is still a massive benefit compared to what most people assume they will owe. There are some important rules and conditions attached to this exclusion, so it is worth reviewing your specific situation with a tax professional before you make any major decisions about selling your home. But for most seniors who have lived in their home for many years, this provision can save an extraordinary amount of money. Bill number 5, penalties on required minimum distributions. The fifth and final bill we're going to cover today is something that catches a surprising number of seniors completely off guard, and that is the penalties and tax consequences associated with required minimum distributions, commonly known as RMD. If you have money saved in a traditional IRA, a 401k, or certain other tax-advantaged retirement accounts, the government requires you to start taking minimum withdrawals from those accounts once you reach a specific age. I quote, and that age has actually been adjusted in recent years due to changes in federal law, so it is worth double-checking where you currently stand. The reason the government requires these withdrawals is simple. All that money was put into those accounts on a pre-tax basis, meaning you never paid income tax on it. The IRS has been patient, but at a certain point they want their share, and they enforce this by imposing a significant penalty if you fail to take your required minimum distribution on time. Now, here is where the IRS quietly provides some relief, and where many seniors miss out on major savings. First, there is a provision that allows certain seniors to make what is called a qualified charitable distribution, or QCD. If you are 70 and a half or older, you can direct up to a certain amount of money each year, currently up to $100,000, or MANT, directly from your IRA to a qualifying charitable organisation. And the incredible benefit of this is that the money transferred to the charity counts toward your required minimum distribution for the year, but it does not count as taxable income for you. This is enormous. Instead of being forced to take a distribution, pay income tax on it, and then donate whatever is left to charity if you choose to, you can transfer the money directly and skip the tax entirely. If you are charitably inclined, this is one of the most powerful tax-saving strategies available to seniors. Second, if you have made mistakes in previous years with your RMDs, either by not taking them at all or by not taking enough, the IRS has historically offered penalty waiver programs that allow qualifying taxpayers to correct those mistakes without facing the full financial consequences. These waivers are not automatic and require the proper documentation and filings, but they have provided real relief to many seniors who found themselves in a difficult situation through no fault of their own. Third, if you are still working past the age at which RMDs normally begin and you have retirement savings in your current employer's plan, you may be able to delay RMDs from that specific account until you actually retire. This is another provision that many working seniors are simply unaware of. The world of required minimum distributions is genuinely complex, and the rules have been changing in recent years. That makes it all the more important to stay informed and to work with a qualified tax or financial professional who can help you navigate your specific situation. Closing segment. Alright, so let us do a quick recap of everything we covered today. Number 1, your medical and healthcare expenses can potentially be deducted from your taxable income, which reduces the overall tax burden on your household and effectively helps erase a portion of those overwhelming medical bills. Number 2, with the right income planning strategy, you may be able to reduce or completely eliminate the federal tax on your Social Security benefits, keeping more of that monthly check in your own pocket. Number 3, between the federal SALT deduction and the various state-level senior property tax relief programs available across the country, many seniors can significantly reduce or even eliminate their annual property tax bills. Number 4, the home sale exclusion provision in the federal tax code allows qualifying seniors to walk away from the sale of their home with up to $250,000, or up to $500,000 for married couples, completely free of capital gains taxes. And number 5, through strategies like qualified charitable distributions, penalty waivers, and proper planning around required minimum distributions, many seniors can reduce the painful tax consequences that often come along with mandatory retirement account withdrawals. Here is the honest truth. The government is not going to call you up and tell you about these benefits. They are not going to send you a letter explaining how to pay less in taxes. And many busy tax preparers simply do not have the time or the specialised knowledge to bring these options up on their own. That is exactly why it is so important to educate yourself, ask the right questions, and work with professionals who truly specialise in retirement and senior tax planning. The information in this video is just the beginning. A starting point to help you understand what is possible and to encourage you to dig deeper into your own financial situation. If you found this video helpful, please do two things right now. First, give it a thumbs up so that more seniors can find this information. And second, consider sharing it with a family member or friend who might benefit from knowing about these programs. And if you have not already subscribed to this channel, now is a great time to do that as well, because we cover these kinds of topics on a regular basis, and we are always working to bring you the most useful and up-to-date financial information for seniors and retirees. Thank you so much for watching. Take care of yourselves, and we will see you in the next one. Disclaimer: this video is intended for informational and educational purposes only. It does not constitute professional tax, legal, or financial advice. Please consult with a qualified tax professional or financial advisor for guidance specific to your individual situation.